All right, let's get straight into it. What you're about to see is not a simple forecast. It's a deep dive analysis, a breakdown of a macro-financial intelligence dossier that outlines a very real, high-probability scenario for a global real estate implosion, and the timeline centers right around the year 2026. We're going to treat this with the analytical gravity it absolutely demands. So here's our roadmap. We're going to proceed methodically. First, we'll expose the core structural flaw. What makes this potential crisis fundamentally different from anything we've seen before? Second, we'll look at the data, the rupture indicators that are flashing red right now. Third, how would an implosion actually play out? We'll dig into the likely scenarios. Then, we're going to go deeper to uncover the unseen risks hiding in the system's plumbing. And finally, we'll confront the biggest question of all: what is the economic endgame? We have to begin with the core thesis here, and honestly, it's a radical one. The argument is that the models we've all used for decades to understand real estate, simple boom and bust cycles, they're not just wrong anymore, they're totally obsolete. We're not in that world. The very architecture of global credit has shifted, and it's created a new, and as you're about to see, a profoundly more fragile paradigm.
This quote, right here from the source dossier, this is the key to everything that follows. I want you to forget about simple corrections or market froth. The argument being made is about a structural breakdown in the plumbing of the global financial system. The pipes and the valves that actually underpin every single property value on this planet. The machine itself is breaking down.
Okay, this is the central vulnerability, and it's a bit technical, but it's absolutely crucial to understand. For decades, anyone holding a mortgage benefited from something called positive convexity. Basically, when rates went down, you could refinance, accelerating your gains. Well, that entire paradigm has inverted. Now we have negative convexity, and that means with every single tick that interest rates go up, the value of those mortgages collapses at an accelerating speed. For banks holding trillions in these assets, this isn't just a loss. It's a nonlinear explosive risk profile where losses mount exponentially, not just one by one.
So this slide maps out what you could call the kill chain, the step-by-step process of how this all unwinds. First, you get prolonged positive real rates, which just relentlessly grind down the value of all assets. Second, as people pull their money out of banks to chase higher yields, the bank's deposit bases just shrink, strangling their ability to lend. Third, the market for trading mortgages, the MBS market, it just freezes. Nobody wants to buy these toxic, negative convexity assets. And that creates the final step, a sudden, absolutely violent repricing event as the entire market is forced to confront reality all at once.
For 15 years, we lived under the Cantillon effect. That meant that when central banks printed money, it benefited those closest to the money printer first, the asset holders. Well, right now, we are witnessing its perfect, brutal inversion. As liquidity gets pulled out, the pain starts at the edges, with homeowners and commercial property owners. Their collapsing asset values, they aren't just personal losses. They are actively destroying the monetary base, creating a deflationary feedback loop that spirals right back towards the heart of the banking system. It's wealth destruction from the outside in.
And this brings us to a conclusion that is, well, it's terrifying. Our safeguards have become our executioners. The sophisticated algorithms that banks use to price their risk, specifically their loss-given default models, these are now the transmission mechanism for the contagion. The second one asset class shows stress, these automated systems instantly reprice risk across the entire portfolio, creating an instantaneous, algorithm-driven panic that moves faster than any human regulator could possibly react to. The risk is no longer outside the system, it's inside the machine.
So the structural flaws we've just laid out, they're no longer just theories. They're actively showing up in the hard data. These next few slides, these aren't forecasts. Think of them as readings from the dashboard of a system that is rapidly approaching a critical failure. 365%. Let that number just hang in the air for a second. This is the projected total global debt to GDP ratio for 2026. And just to be perfectly clear, this is a level that has absolutely no historical precedent. It signals a global economy so completely saturated with leverage that it's reached a kind of terminal state. You see, at this level of debt, the global economy hits a state of terminal debt saturation. Every new dollar of debt isn't for investment anymore, it's not for growth. It's just triage. It's used simply to service the interest payments on the old debt. The economic engine isn't moving forward, it's just spinning its wheels, burning all its fuel just to stay in one place. The system becomes this giant feedback loop of non-productive credit, making it fundamentally unstable and just poised for what's known as a Minsky moment, a sudden, violent collapse. Greater than 2.5%.
This right here is the critical threshold for the 10-year U.S. Treasury real yield. That's the true return an investor gets after you subtract inflation. Now, this isn't just a number for bond traders. This is the anchor for the entire global financial system. And when it crosses this line, the fundamental math that justifies real estate as an investment, it just breaks.
And here it is. This is the precise transmission mechanism from the bond market to the physical real estate market. For decades, the logic has been simple. Big institutions buy property because its rental yield, the cap rate, is higher than the risk-free return they could get from a government bond. Well, the very moment that real yield on a bond surpasses 2.5%, that logic completely inverts. The entire capital allocation model for global real estate simply breaks down.
Just look at this chart. We are not just at an affordability low, we are at what's called a 4-standard deviation event. Now, in statistical terms, this is an anomaly that really shouldn't even exist in a functioning system. It's a measure of extreme, unbelievable tension. A spring that is coiled this tightly does not gently unwind, it snaps back with violent force. The 2007 peak, that was a 2 sigma event. We are now projected to be double that.
Negative 6%. Now, this isn't a stock market decline. This is the annualized contraction rate of the M2 money supply. That's the total stock of all currency, checking accounts, and savings deposits in the economy. This means money isn't just being printed more slowly, it is actively being destroyed. Money is literally being vacuumed out of the system at a pace we have not seen since the Great Depression. And for the real estate sector, which runs entirely on credit, this is absolutely catastrophic. Developers who desperately need to refinance their construction loans are finding the taps have just run dry. Projects stall, companies fail, and we're looking at a wave of unfinished, bankrupt developments that will litter the landscape.
Less than 1.1. This is the projected average debt service coverage ratio, or DSCR, for the entire U.S. commercial real estate sector. This ratio is the ultimate measure of financial health for a property. It's simple. It measures the cash flow available to pay the debt. And when it gets this low, it's a screaming signal of systemic insolvency.
To be crystal clear, this number represents the threshold of technical insolvency. A DSCR of 1.1 means that for every single dollar of debt you owe, the property is only generating $1.10 in income. Once that number dips below 1, default isn't a risk, it is an accounting certainty. The dossier projects the entire sector will cross this Rubicon, triggering a wave of defaults on a scale that will make 2008 look small.
Okay. So, we've established the deep structural flaws, and we've seen the warning lights flashing red all over the data dashboard. So now, let's simulate the 2 most likely ways this implosion actually happens. How does the crisis mechanically unfold? The dossier models 2 primary scenarios. Now, they aren't mutually exclusive. They could happen together, but they describe different ways the crisis kicks off. The first is a liquidity-driven seizure. Think of it like a deflationary heart attack. The second is a solvency-driven cascade, more like a chain reaction of forced liquidations.
So in the flash freeze, the market doesn't crash in the way you'd think. It simply ceases to exist. Bid-ask spreads widen to infinity. No one will buy and no one can sell. This leads to a total failure of price discovery. And because there are no transactions, official price indexes look deceptively stable. But under the surface, the only activity is creditors foreclosing on assets and dumping them in opaque, off-market deals at 40-50 cents on the dollar. The real crash is hidden from view.
Now, the contagion spiral is a much more visible top-down collapse. It starts when investors panic and pull their money from the big real estate funds, the REITs. To meet those redemption calls, the funds are forced to sell their best assets first, the trophy properties in prime locations. This fire sale crashes the high end of the market, which instantly triggers margin calls for any investor who used those properties as collateral, forcing them to sell their assets, and on it goes, in a vicious, self-reinforcing downward spiral.
Now, beyond these primary mechanics, the system is packed with hidden amplifiers, these less obvious, often totally unregulated fragilities that will dramatically worsen the outcome. We have to examine this hidden architecture of the crisis.
This is such a critical concept. It basically means there is no easy way out of this. Even if central banks pivot and they slash interest rates back to zero, lending won't just restart. And why not? Because the risk models inside the banks will have been so traumatized, so scarred by the scale of the losses, that they will simply refuse to extend credit. The institutional memory of the crisis creates this credit scar, which makes monetary policy totally ineffective and traps the economy in a long, painful slump.
And here is where we find the dark matter of this crisis.
Nearly half, think about that, almost half of all real estate lending now happens outside the regulated banking system. It's coming from private equity funds, debt funds, all these other shadow lenders. This entire network is opaque, it's highly leveraged, and crucially, it has no access to a central bank backstop. When it starts to collapse, the contagion is going to spread through channels that regulators literally cannot see or control. This is the true systemic risk of our era.
This leads to an unavoidable conclusion. The current stated value of the global commercial real estate market is a complete fiction. It's based on appraisals from a zero interest rate world that no longer exists. There's this industry-wide unspoken agreement not to reappraise assets, not to survey them, because doing so would force institutions to recognize trillions of dollars in latent losses on their books. It's a dam of denial, and when it finally breaks, a tidal wave of mark-to-market losses will wipe out the equity of countless funds and banks.
And this creates a deeply, deeply perverse outcome. We have a structural housing shortage in many Western countries, yet at the exact same time, the construction sector is becoming zombified. Builders are technically insolvent, kept alive only by rolling over their existing debt. They have no access to new capital to actually buy materials and pay labor to finish their projects. This leads to the bizarre paradox of a severe housing crisis coexisting with a landscape of half-finished bankrupt construction sites.
Okay, so having dissected the entire architecture of the crisis, we arrive at the final critical question. When all the dust settles, what is the nature of the economic reality that's left? The dossier presents two competing and frankly equally grim theses for the endgame. So the debate is really between two fundamentally different kinds of economic catastrophe. The first is a classic 1930s-style debt deflation, where the value of both assets and money just collapses. The second is a uniquely modern stagflationary shock, where the entire market freezes in a state of high prices and zero activity.
The first scenario follows the classic model from the Great Depression. It's basically a feedback loop from hell. As loans default, the money that was created to fund them is just erased from the system. This reduction in the money supply causes all other prices to fall. This deflation then makes the remaining debt even heavier in real terms, which triggers more defaults, which destroys more money, pulling the entire economy into a vicious downward spiral.
Now this is the alternative, and in some ways, maybe the more terrifying scenario. Here, nominal property prices don't actually collapse. Why not? Because the cost to build a new replacement, the cost of concrete, steel, copper, skilled labor, has exploded, and it remains stubbornly high. This creates a residual supply crisis. Existing properties are completely unaffordable to the average person, but it's impossible for developers to build new ones any cheaper. So the market doesn't clear, it just freezes, locked in a state of profound economic stagnation, surrounded by persistent high costs.
And so, this is the final question posed by the analysis. Will this coming implosion follow the historical script of a debt deflationary depression, which cleanses the system through a painful but definitive collapse? Or are we entering some new paradigm, a stagflationary paralysis, where the market is just trapped, frozen between prices that are impossible to afford and costs that are impossible to reduce? The entire structure of our economic future really hangs on that answer.